Somewhere in the Swiss Alps, there is a vault. You will never see it. You will never know whose money is inside it. And the people whose money it holds would very much like it to keep it that way. Switzerland is not the biggest country in the world. It has no ocean access, no oil, no empire. It is roughly the size of West Virginia, and it is surrounded on all sides by larger, more powerful nations. Nations that have, at various points in history, tried to absorb it, pressure it, or simply ignore it. And yet, for over 200 years, Switzerland has quietly held the financial secrets of kings, dictators, oligarchs, and corporations. At its peak, Swiss banks were estimated to hold somewhere between $6 and $8 trillion in foreign assets. Some estimates go higher. Nobody knows the exact number because that is, rather famously, the point. This is not a story about chocolate or watches or skiing. This is the story of how a small, landlocked country built the most powerful financial fortress in human history, and how it did it not with weapons or resources, but with something far more valuable: silence. Let us go back to the beginning. It is the early 1700s. Europe is a mess. Wars are constant. Borders move. Monarchies rise and fall. Every king and every merchant in Europe desperately needs somewhere safe to put their money while the world falls apart. Switzerland at this point is not rich. It is actually struggling. It is a confederation of small mountain cantons with limited farmland and no natural resources. What it does have, however, is something unusual for the era: stability. Switzerland had been officially neutral since 1515. After a major military defeat, they reached a simple conclusion. They were not going to win wars against major powers, so they would stop fighting them. They would trade with everyone, fight for no one, and make themselves diplomatically inoffensive. While France, Austria, and Prussia tore each other apart, Switzerland sat quietly in the middle. The Swiss bankers understood what they were being offered, not just deposits, but trust. In 1713, the Great Council of Geneva passed regulations requiring bankers to keep records, but prohibiting them from sharing those records with anyone. It was a promise, and it was a promise the Swiss kept. Then came 1934, and everything changed. Adolf Hitler had come to power in Germany. The Nazi regime made it illegal for German citizens to hold foreign bank accounts. The penalty was death. This created a problem. Swiss banks were holding enormous amounts of money from Jewish families and political dissidents. The Nazi government sent agents into Switzerland to identify these account holders. In response, Switzerland passed the Federal Banking Act of 1934. It made it a serious criminal offense for any bank employee to disclose client information without consent. Banking secrecy was no longer just a norm, it was now the law of the land. Officially, this protected the persecuted, but the law made no distinctions. It protected everyone equally, including those who wanted protection from taxes, accountability, or the consequences of their crimes. The Swiss would tell you the law was a shield. Critics would say it was a vault door. And they were both right. Here is how it actually worked. In the 20th century, you could open an account under a number, not a name. The bank knew who you were, but only a handful of people ever had access to that private ledger. If a foreign government claimed tax evasion, the Swiss government would decline to help. Under Swiss law back then, tax evasion was not a crime serious enough to warrant breaking secrecy. By the 1960s and 70s, Swiss banking had become a global institution. Dictators from Latin America and Africa parked looted national treasuries in Zurich and Geneva. Organized crime figures and giant corporations used Swiss accounts to hide assets. Switzerland grew extraordinarily wealthy. Its per capita income became one of the highest in the world. The country with no oil and no empire had engineered a permanent seat at the table of global finance. But the cracks started to appear in the 1990s. Holocaust survivors began demanding access to dormant accounts. In 1998, Swiss banks agreed to pay $1.25 billion to settle these claims. Then came American pressure in the 2000s. The U.S. Department of Justice went after UBS for helping American clients commit tax fraud. UBS eventually paid a $780 million fine and, for the first time, handed over 4,500 names. In 2010, the U.S. passed FATCA, forcing foreign banks to report American account info or face massive taxes. Swiss banking secrecy, as it had existed since 1934, was functionally over. Or was it? Switzerland did not become a transparency paradise, it adapted. Numbered accounts gave way to complex trusts, foundations, and shell companies. Today, Switzerland remains a financial architect, serving as a pressure relief valve for the failures of governance everywhere else. The country that perfected neutrality did it by profiting from both sides of every conflict. So the question remains, when your product is the absence of oversight, at what point does neutrality become a business model? The money is still flowing, quietly, as it always has.